Welcome to The Explainer. In the world of finance, there's a huge question that everyone's trying to answer. What should an asset really be worth? Well, today, we're digging into a really powerful tool for that, the Arbitrage Pricing Model, or APM for short. You've got Warren Buffett saying his favorite holding period is forever. But even for him, the price you pay right at the start is absolutely crucial. For decades, one model was king, telling everyone what that price should be, until, well, a pretty big flaw showed it wasn't telling the whole story. So our story kicks off with the old champion of asset pricing, the Capital Asset Pricing Model, which you probably know as CAPM. Now, the beauty of CAPM was its simplicity. It was stunningly simple. It said that an asset's expected return really just depends on one thing: how sensitive it is to the wiggles of the overall market. How much does your stock zig when the whole market zags? That was pretty much the only question that mattered. But by the 1970s, people started to see some serious cracks. The model's assumptions just felt way too perfect for the messy, real world of markets. A huge critique, famously from Richard Roll, pointed out that its main ingredient, this thing called the market portfolio, was basically a theoretical ghost. You can't actually see it or measure it, which means you can never really test the model. This whole situation really opened the door for a new challenger. An economist named Stephen Ross came up with the Arbitrage Pricing Model, and he built it not on a bunch of rigid assumptions, but on a simple, powerful economic law that, honestly, anyone can get. The entire foundation of the APM, the whole thing, rests on a concept you already know, probably without even thinking about it: the law of one price. So this law just states that the same exact item can't sell for two different prices at the same time. If it does, people are going to jump on that difference to make a profit. That whole process is called arbitrage. It's the force that makes sure there's really no such thing as a free lunch. Okay, so how does this actually play out in the financial markets? Imagine you've got two portfolios. They have the exact same risk profile. They're identical in that way. But for some weird reason, portfolio A is expected to give you a 15% return, while portfolio B is only expected to give you 13%. So what's the smart move here? Well, you'd pull off what's called an arbitrage trade. You would sell the portfolio that's underperforming, and at the exact same time, use that money to buy the one that's outperforming. And since they have the exact same risk, those risks just cancel each other out. What you're left with is a pure 2% profit with zero risk and zero of your own money tied up. It's basically a money machine. Now, think about what happens when everybody starts doing this. All that selling pressure pushes the price of the loser down, and all the buying pushes the price of the winner up. This keeps happening until their expected returns line up perfectly, and that free lunch just disappears. The market snaps back into place. And that powerful, self-correcting engine is exactly what the APM is built on. And this brings us to the single biggest difference between these two models. While CAPM really only sees one source of risk, the market, APM says, hey, wait a minute, the world is way more complicated than that. APM starts by breaking down where an asset's return comes from. It says the return is made up of what you expect to get, plus some random noise. And then, this really crucial third piece, the asset's sensitivity, its beta, to unexpected shocks from some big economic factor. But we all know it's never just one thing that moves the market, right? You could have an unexpected spike in inflation, or a sudden slowdown in industrial production, or a surprise change in interest rates. These are all totally separate risks that hit different assets in different ways. And this is where the APM is just brilliant. It's flexible. It argues that an asset's return isn't just tied to one risk factor. No, it's a combination of its unique sensitivities to all of these different economic forces, and each one gets its own beta. So for example, an airline stock might be super sensitive to oil prices, while a bank stock is way more sensitive to interest rates. APM can handle both of those at the same time. All right, so let's put these two models in the ring, head to head. You're about to see just how differently they look at the world. So CAPM is rigid. It's a single-factor model, and it lives and dies by that theoretical, invisible market portfolio. APM, on the other hand, is flexible. It's a multi-factor model, and you can actually test it in the real world. It doesn't need the market portfolio, and it's based on fewer and frankly more realistic ideas about how markets and investors actually behave. So is APM just the better model? Well, it's not quite that simple. While it definitely solves some of CAPM's biggest headaches, it kind of introduces a few new ones of its own. The advantages are pretty clear. The assumptions are more realistic. You don't need that ghost market portfolio, and it gets that there can be multiple sources of risk. It just gives you a more nuanced and practical way to think about what's driving your returns. But here's the catch. The EPM is kind of like a recipe that just says add spices to taste. It doesn't tell you what the risk factors actually are. Researchers have to go digging through tons of data to find them, and a lot of times, the factors that pop out, well, they don't always have a clear, intuitive economic meaning. And that leaves us with a final, really important question for anyone working in finance. What's more useful in the end? A model that's simple, elegant, and wrong, or one that's flexible and realistic, but ultimately leaves the most important choices up to you to figure out?